There are moments in market history when volatility becomes more than a temporary interruption, it becomes a lens into the future. Drawdowns often feel uncomfortable, even punishing, especially when they hit innovative sectors the hardest. But if we examine past cycles, we see a consistent truth. Drawdowns don't signal the end of progress. They precede periods of exponential growth. And right now, the signals I'm seeing are remarkably similar to those transformative moments when markets recalibrate before unlocking a new era of opportunity. What we're experiencing is not a collapse of innovation, it is the recalibration of expectations. Markets have been digesting years of tightening, uncertainty, and rapid macro adjustments. But beneath that surface-level turbulence, the foundations of disruptive innovation have only strengthened. When you look closely at the technologies leading the next decade, artificial intelligence, robotics, multi-mix, energy storage, blockchain infrastructure, the rate of adoption is accelerating, not slowing. Historically, drawdowns in periods of exponential technological change have proven temporary because the underlying growth trajectories remain intact. One of the key indicators that drawdowns may be nearing their end is the shift in monetary policy. Markets often bottom not when the Fed begins cutting rates, but when it stops hiking aggressively and telegraphs stability. We've passed that inflection point. Real interest rates are stabilizing, inflation expectations are moderating, and liquidity is gradually returning. As financial conditions ease, capital begins flowing back into high growth, high innovation spaces that were temporarily discounted. These sectors tend to lead recoveries because they compound at rates traditional industries struggle to match. Another powerful force pointing toward the end of this drawdown period is the corporate adoption of breakthrough technologies. During market declines, many assume companies will cut back on innovation spending. But this cycle has defied that assumption. Enterprises are not only maintaining their investments in automation, AI, cybersecurity, and digital transformation, they are accelerating them. The cost curves are falling so quickly, and the productivity gains are so large, that delaying adoption becomes more expensive than moving forward. This corporate reinforcement accelerates the broader transition and supports valuations long before retail or institutional inflows return. We also cannot ignore the dynamics of earnings. Innovative companies often lead in top-line growth even in volatile markets, and while traditional metrics like short-term profitability can temporarily compress valuations, long-term revenue trajectories continue marching upward. Historically, when earnings resilience remains strong while valuations contract, markets reach a point where sentiment alone can no longer justify the discount. That is when long-term investors step in, and that step often marks the end of major drawdowns. Investor psychology plays a role as well. Drawdowns persist until pessimism peaks. Today, many sentiment measures, fear indicators, risk-off positioning, retail outflows are already at levels historically associated with late-stage declines, not early-stage ones. When the market narrative becomes fully skeptical at the same time fundamentals remain strong, that disconnect becomes a catalyst. Markets tend to recover suddenly before the majority feels ready because they price in the future, not the present. Finally, innovation platforms are crossing cost thresholds that could ignite the next wave of market expansion. The cost of training AI models is collapsing. Battery prices continue to decline, unlocking new applications for electric mobility and grid storage. DNA sequencing is approaching accessibility at scale. Robotics is on the verge of mass deployment. These breakthroughs create new profit pools, new business models, and new competitive advantages, the exact ingredients that fuel recoveries after prolonged drawdowns. So when will market drawdowns subside? Not when sentiment feels perfect, not when headlines turn optimistic. They will subside when fundamentals overpower fear, and that moment, based on everything we are tracking, is approaching. The seeds of the next bull market are already planted. The question now is not whether markets will recover, but who will be positioned when they do. there is a quiet shift happening beneath the surface of global markets, one that most investors are not prepared for. The traditional frameworks, the valuation models, even the way people interpret risk and reward, are being outpaced by the velocity of technological change. When disruption accelerates at multiple layers simultaneously, markets tend to underestimate its impact until the transformation becomes undeniable. And right now, the signals are pointing in one direction. We are heading into a period where breakthroughs in automation, AI, robotics, and autonomous mobility converge into an economic force unlike anything we've experienced. The challenge is that most analysts still anchor to linear expectations. They extrapolate the past instead of projecting the exponential. They look at old cost structures and assume they remain relevant. They miss how quickly innovation scales once it crosses critical price thresholds. They underestimate the compounding effect of intelligence, machine intelligence, that learns, adapts, and improves every day without fatigue or diminishing returns. This is why so few are prepared for what's coming. The world is shifting towards systems that automate decision making, manufacturing, driving, financial allocation, and even scientific discovery. And these systems are improving at a rate that defies legacy financial modeling. Take autonomous mobility. Many still assume full autonomy is years away, but the data says otherwise. Every mile driven by autonomous systems increases their intelligence. Each software update reduces error margins that were once considered insurmountable. And as costs decline, fleets will scale faster than the world expects. When autonomous platforms reach commercial readiness, global transportation economics will be rewritten. Ride-hailing costs could collapse, urban design will evolve, and logistics will achieve unprecedented efficiency. The companies positioned at the center of this shift won't just gain market share. They will redefine entire sectors of the global economy. Now consider robotics. The assumption that robots are niche tools is outdated. We are entering an era of general-purpose robotics, machines capable of performing dynamic, multi-step tasks that traditionally required human intuition. Lower costs and improved dexterity are enabling robots to move from controlled environments into everyday settings. Manufacturing, warehousing, healthcare, construction, these industries will see productivity gains that compound year after year, and the ripple effects will be massive. Entire labor structures will evolve. Business models will reorganize around automation. And countries that adopt robotics aggressively will gain a structural economic advantage. Artificial intelligence is the backbone of all of this. The cost of training models is falling rapidly, while inference capabilities are improving exponentially. AI is no longer a tool, it's becoming infrastructure as essential as electricity, communication networks, and the internet itself. Companies leveraging AI to automate research, decision making, and operational workflows are achieving breakthroughs at speeds that once took entire research labs years to accomplish. And as AI integrates with robotics and autonomous systems, we will witness productivity levels the world is simply not prepared for. The intersection of these innovation platforms, AI, robotics, energy storage, autonomous mobility, creates a multiplier effect. Each breakthrough accelerates the next. Each decline in cost expands adoption. Each new dataset improves performance. This compounding cycle is why the world is on the verge of a transformative shift that will look sudden to those who have been ignoring the signals for years. Most investors still focus on short-term cycles, market fear, and traditional indicators that have little relevance in a world driven by technological deflation. They are not ready for industries that scale 10x faster than the norm. They are not ready for capital flows that chase exponential growth rather than incremental improvement. They are not ready for a global economy rebuilt on automation, intelligence, and efficiency, but readiness has never been a requirement for disruption. Transformation arrives whether the world predicts it or not, and those who understand the trajectory, not the noise, will see that the next decade will not resemble the last. The future is coming faster than expected, and very few are positioned for the magnitude of what's about to unfold. The reaction to these predictions about the future of work isn't surprising. Whenever technology challenges deeply rooted assumptions, society responds with disbelief, concern, and even outrage. But if we move beyond the emotional response and look at the underlying technological and economic signals, the direction becomes clear. We are approaching an inflection point where labor, productivity, and human contribution will be redefined more dramatically than at any time in modern history. The debate is not about whether automation will impact jobs. That part is indisputable. The real question is how quickly the shift will occur and what the new equilibrium will look like. For decades, automation has replaced repetitive manual tasks. But what's emerging now is fundamentally different. With breakthroughs in AI, robotics, and general-purpose autonomous systems, we are nearing the point where technology can perform not just mechanical work, but cognitive work, problem-solving, pattern recognition, analysis, decision support. As these systems scale, the cost of labor supplied by machines continues to fall, while the intelligence embedded in these systems increases exponentially. What many people find shocking is not the idea that automation will continue, but the speed at which it is accelerating. AI models now learn in days what once took years. Robots that were once rigid and single-use are now flexible, capable of multi-step operations, and increasingly mobile. Autonomous platforms gather real-world experience at a pace no human workforce could ever match. All of this contributes to a deflationary force in the labor market, not destructive deflation, but productive deflation, where the cost of creating value drops dramatically. The outrage stems from fear of displacement, fear of irrelevance, fear of losing control over one's livelihood. But technology cycles show a consistent pattern. When new platforms emerge, society often assumes a zero-sum trade-off. Yet historically, these platforms create entirely new categories of work, expand productivity, and unlock industries that didn't previously exist. The difference this time is that the transformation is not incremental, it's exponential, and that pace challenges the human ability to adapt quickly. The key to understanding this shift is to focus on the economics of abundance. As automation takes over tasks that are dangerous, monotonous, or purely mechanical, human creativity becomes more valuable. The work that remains and the work that emerges centers on originality, oversight, strategic thinking, emotional intelligence, ethical judgment, and design. In other words, humans shift from being the primary labor force to becoming the architects, supervisors, and visionaries of systems that scale infinitely. Whether people agree with the prediction or not, the data does not lie. Robotics adoption is accelerating globally. AI deployment in business operations is becoming standard rather than experimental. General-purpose robots, once considered science fiction, are now commercially viable. Autonomous systems are moving from pilot programs to real-world integration. These signals point to a future where humans and machines collaborate, but the ratio of machine labor to human labor shifts dramatically. Instead of framing this transition as job elimination, we should view it as job evolution. Entire sectors like autonomous logistics, AI-integrated healthcare, digital education, virtual production, and robotics maintenance will require millions of new roles. And history tells us that when technology makes certain forms of work unnecessary, society reallocates human potential into higher value domains. The outrage, therefore, is a natural reaction to an uncomfortable truth. The future of work will not look like the past. But resistance will not stop the trajectory. The real opportunity lies in embracing this transformation with clarity, not fear, focusing on innovation, retraining, and new economic models that support a world where productivity is increasingly decoupled from traditional labor. The prediction may be shocking, but the future it points to is filled with unprecedented possibility. Volatility in the crypto markets often appears chaotic from the outside, but when you examine the underlying data, patterns emerge that make one thing clear: the recent crash was not a random event. It was a recalibration, a technical, psychological, and structural reset that tends to occur when disruptive technologies approach critical adoption thresholds. What looked like panic selling on the surface was, in reality, the market responding to a series of predictable forces: liquidity tightening, regulatory posturing, leverage unwinding, and automated trading cascades. These are not anomalies. They are part of the natural maturation of any asset, transitioning from speculative enthusiasm to long-term institutional integration. The crash itself revealed something powerful about Bitcoin. Despite short-term turbulence, the long-term fundamentals didn't deteriorate. Hash rate remains near all-time highs, signaling unwavering confidence from miners, the backbone of the network. Long-term holders still hold the majority of supply, a stark contrast to early cycles when retail investors dominated the float, and institutional infrastructure, custody, liquidity, compliance rails has never been stronger. These are not the characteristics of an asset losing relevance. They're the hallmarks of an asset preparing for its next phase of evolution. What triggered the downturn was a combination of leverage and emotion, not a breakdown in Bitcoin's technology or mission. In every cycle, excess builds in the form of overextended derivatives, speculative altcoins, and traders chasing parabolic moves. When liquidity tightens, whether due to macro tightening, risks, off sentiment, or geopolitical uncertainty, these leveraged structures unwind violently. Automated liquidations accelerate the fall. Momentum amplifies fear. It plays out like a system purge, flushing out short-term speculation while leaving the core architecture untouched. Far from an accident, it is precisely how markets reset before a new leg of growth. What comes next is determined not by emotion, but by structural trends. One of the most important is institutional demand. This demand doesn't chase rallies, it accumulates in periods of dislocation. Large pools of capital pension funds, sovereign funds, asset managers do not view crashes as reasons to exit. They view them as opportunities to enter at discounted prices. Their focus is not weak volatility, but multi-year allocation strategy. And with Bitcoin increasingly recognized as a digital monetary network with capped supply, its role as a hedge against long-term monetary debasement becomes clearer each cycle. Another force shaping the future is technological evolution. Layer 2 scaling solutions are expanding transaction capacity at a pace that transforms Bitcoin from a store of value only asset into a base layer for broader economic activity. Interoperability across chains is improving. Settlement efficiency is increasing. These advancements strengthen the network's utility and set the stage for new applications that could dramatically increase demand. Regulation, often perceived as a threat, is now trending toward clarity rather than chaos. Clear frameworks reduce uncertainty, attract traditional capital, and open the door to widespread corporate adoption. The crash pushed policymakers to accelerate conversations they've been delaying, and while regulation may introduce short-term friction, it ultimately builds long-term stability. The psychology of the market is also shifting. Each cycle educates a new generation of investors who learn to distinguish noise from signal. After every crash, the base of informed, resilient holders expands, reducing the probability of future panic-driven collapses. This maturing investor base is one of Bitcoin's most underappreciated strengths. So what comes next is not collapse but reconstruction. The market will stabilize, liquidity will return, narratives will shift from fear to opportunity. And as the macro environment evolves, Bitcoin's value proposition decentralized, scarce, borderless, transparent becomes increasingly relevant. Crashes may dominate headlines, but the underlying story remains the same. Each downturn clears the runway for the next wave of adoption. The future is not determined by the crash. It's determined by the forces that remain standing after it.